amortization of loans. So in this chapter, when we're dealing with amortization, we're dealing with basically amortization is a repayment of interest-bearing debt that is made by a series of payments, usually in equal size and equal time interval, right? So this is basically your PMT, right? So we're making a series of payments, which is your PMT, and that payment is usually equal size and equal interval. That's basically the definition of PMT. And when we're looking at calculating amortization, there's two methods. The first method is called the retrospective method, and that's basically when we have the original amount financed is known, so when we have the present value is known, so when we know exactly how much we're borrowing, so which is the normal case, we know exactly how much we're borrowing, and then we're just computing for PMT, and the final payment will be different. And the second method is your prospective method. This is when we know that all the payments are the same, and then we compute for PV. Okay, so those are the two methods. Retrospective, we know PV, we compute for PMT. Prospective, we know PMT, we compute for PV. So those are the two methods. And the first method is more common because when we borrow money from the bank, when we get a mortgage, we know exactly how much money we're borrowing. This is your PV, that we know exactly how much money we're borrowing from the bank, and then we just compute for our monthly mortgage payments. Next is definition about residential mortgage in Canada. So when we're looking at the residential mortgage in Canada, and we look at how bank approving their mortgage, basically the criteria are set by a Crown corporation called CMHC, and they set pretty much the rules for how banks approve the mortgage. And there are two ratios that they look at. The first ratio is the gross debt service ratio, GDS, and the second ratio that they look at is the TDS, total debt service ratio. Okay, what the GDS states is that basically your housing cost should be no more than 32% of your monthly income. So your monthly housing cost, your MHC, should be less than or equal to 32% of your monthly income. And your monthly housing cost includes your property tax, it includes your mortgage payment, it includes the utility, the heating cost. So it's not just the mortgage payment, it's the mortgage payments plus the property tax plus the heating cost, your utility, and so on. And the second ratio that they look at is TDS. Basically what they're saying is that your TDS, your monthly total debt load, should be less than or equal to 40% of your monthly income. So that's the second criteria that they look at. When you go to the bank and you look for how much mortgage you can be approved for, you need to satisfy both conditions. And what the monthly debt load look at is that basically monthly debt loads look at not just the monthly housing costs, but it looks at also your other debts as well. So like your student loans, your car loan, your credit card bills, all that as well. So not just your housing costs, but your housing costs plus your other debts obligations. And that has to be less than or equal to 40% of your monthly income. So those are two criteria that the CMHC sets. And those are the criteria that the banks look at. The next definition that you need to know is fixed rate and versus variable rate. So fixed rate and variable rates basically are referring to the interest rate. So fixed rate means that the interest rate is fixed for the entire term. Variable rate means that the interest rate will fluctuate according to what the prime rate is. And the next terminology that you need to know is open and close. Okay, so what you need to know is that open is basically referring to how much, open and close is referring to how much prepayment you can pay without taking any penalty. Okay, so open means that you can pay off your mortgage entirely without any paying penalty. Close means that you can only pay up to 10% of your original mortgage balance. Okay, so don't be confused by fixed and close. Okay, so fixed does not equal to close, right? So fixed interest rate is referring to the interest rate. We're locking in the interest rate. It's different than closed mortgage. Okay, so don't get confused by that. Closed mortgage just means that you can pay up to 10% of your mortgage balance. You can make lump sum payment of up to 10% each year without any penalty. So that's what close mean. And fixed is referring to fixing the interest rate. So they're two different things. And then the next terminology that you need to know is term of the mortgage and amortization. So amortization is when you can pay off your mortgage. That's amortization. So amortization is usually 25 years. So that means you're going to pay off your mortgage after 25 years. So that's the amortization period of the mortgage. When we're looking at the term of the mortgage, we're just looking at how long we're locking in the interest rate for. So how long we're fixing the interest rate for. So that's what the term of the mortgage is. So term of the mortgage are usually shorter. Term of the mortgage are usually 1 to 5 years. while the amortization period of the mortgage is usually 25 years, right? So 25 years for you to pay off the mortgage, and you're locking in the interest rate usually for 1 to 5 years. So that's what the term of the mortgage means. You're locking in the interest rate for 1 to 5 years.